from the Financial Sector Conduct Authority, and we are bringing you another webinar that we're very excited about today. I am joined by very experienced and esteemed colleagues from the Financial Intelligence Center today, the absolute experts on the topics we're going to discuss, and they are Yolande Plaatjies and Mzwandile Mavuso. They are from the Guidance and Prevention Department in the Financial Intelligence Center. On our side in the FSCA, we have Gemotso Molefi. She is a colleague of mine in the FICA Supervision Department. Say hi, Gemotso, and also Mpo Gadebe, also who joined us a couple months ago in the FICA Supervision Department. So we're here to give you today insights about a topic that's very important and that deals with amendments to the FIC Act, as well as guidance that has been issued and will continue to be issued by the Financial Intelligence Center. The reason we decided to do this webinar early in the new year is because the amendments to the FIC Act has been very recent. So as you may know, I'm sure you're aware by now, that South Africa was subject to a mutual evaluation that was conducted by the Financial Action Task Force in 2019. When the Financial Action Task Force published their report in October 2021, amongst certain deficiencies, they identified very specific technical compliance deficiencies. Now, our country, under the leadership of the National Treasury, has made great strides in amending our legislative framework, and we're going to delve into that today because it also touches on the guidance that Yolande and team is going to explain to us. Also on our agenda today is Draft Directive 6 of 2022 and Public Compliance Communication 116 of 2022. For the benefit of not overburdening you with jargon, public compliance communication, I'll be referring to in layman's terms just as a PCC. That particular draft PCC deals with screening of employees for competence and integrity. So there's obligations placed on accountable institutions, not just in terms of screening of customers, but also staff. So if you have not been aware of that, today is the day that you will be informed of what these duties are and to how in practice to do that. We're also going to look at PCC 44, that is guidance on customer due diligence in relation to shared clients. So I'm very curious to hear from you, Yolande, what you're going to tell us about first party and third party accountable institutions, and what's the purpose of this guidance, so that our esteemed viewers will be very educated after this webinar. Then we're going to look at PCC 49, and that is guidance on money laundering, terrorist financing, and proliferation financing risk considerations related to geographic areas. Moving from there, Draft Guidance Note 7A, and I've got questions for Yolande because we all know Guidance Note 7 very well. It was published in around October 2017 when the amendments to the FIC Act came into effect back then, 6 years ago already nearly. So I think this one is going to be one for the books and that we need to really watch out for. Then Public Compliance Communication 51 on guidance on measures relating to what we used to know as foreign prominent public officials and domestic prominent influential persons, their family members and known close associates. And you'll see we'll touch a little bit on this as well when we talk about the amendments to the FIC Act. Second to last, PCC 44, that is guidance on the application of targeted financial sanctions regime in our country. Again, very, very topical, especially following our mutual evaluation. And last but not least, PCC 54, guidance on compliance measures aimed at combating proliferation financing. And I'm going to touch a little bit on that when I deal with the FIC Act amendments as well. Right. So I mentioned the mutual evaluation, and I said that the FIC Act was amended. And every time there's an amendment, we tend to get a bit nervous and we're scared of the change, and we're not always 100% sure what this means for us as supervisors or accountable institutions. Hence, we're carving out the time today to take you through the amendments. On a high level, you still have to go and read up on this and really familiarize yourself with these amendments, and then supplement that with the guidance that Yolande and team will talk us through, because the guidance really, in our experience, helps us to understand what the legislation actually expects from us on a more practical level. So when, under the leadership of National Treasury, the legislation in South Africa had to be amended, it was decided that instead of taking each piece of legislation in a siloed approach through the parliamentary process, to put them all in one bucket and with one go have those amendments enacted. So the General Laws Anti-Money Laundering and Combating Terrorism Financing Amendment Act was signed off by the President late last year when everyone was at the beach. He was still working and signing off legislation, and it has been published in the Government Gazette on 29 December last year. So we've provided the details of the link there for you. Please go onto the website, go look up that Government Gazette, and we've even made it easy to tell you which pages to go look at, where the focus is specifically on the FIC Act amendments. Now, the General Laws Amendment Act did not just provide for amendments to the FIC Act. There were other pieces of legislation also now amended through this process, such as the Non-Profit Organizations Act, the Trust Property Control Act, and even the Financial Sector Regulation Act. But because we are going to deal with FIC Act amendments today, that's where our focus is going to be. Now, these amendments predominantly in the FIC Act, as I mentioned, one can sometimes feel overwhelmed when there's a lot of change. But to make this, or to try and make this a little bit easier for you as our viewers, we tried to categorize the amendments. So there has been amendments to definitions, existing definitions, as well as insertion of new definitions. And the main ones really jump out as relating to definitions regarding the definition of beneficial ownership, the definition of politically exposed person, a new insertion of a definition for prominent influential persons. And you'll also note that with the amendment of these definitions, they're not isolated. So they also speak to certain sections in the FIC Act that have been amended accordingly. So they have to be read together. Now, first of all, let's have a quick look at the definitions, the changes to the definition of politically exposed persons. Yolande and team is definitely going to elaborate on that because there's specific guidance issued by the FIC on this topic. But basically, the two main changes there is it relates to the naming convention, and now formally cementing into our legislative framework the concept of once a PEP, always a PEP. Then there has, of course, also been a few changes with regards to objectives, functions, powers of the Financial Intelligence Center. One of them I'd like to highlight is the FIC now has the power, one of the objectives rather. It includes an objective to produce forensic evidence based on the application of specialized scientific methods and techniques. So this is very exciting. And this pertains specifically to the flow of financial transactions and the links between persons and property based on the flow of financial transactions. You would, as accountable institutions, also be very familiar by now with Section 42 of the FIC Act. Yes, colleagues, that is section dealing with risk management and compliance programs. There has been quite a few amendments to Section 42. First of all, on a high level, an accountable institutions risk management and compliance program, in short your RMCP, now has to not just provide for identifying and developing effective controls to mitigate the inherent risk related to money laundering, terrorism financing, but also proliferation financing of weapons of mass destruction. Again, that's one of the new definitions inserted in the Act. There has also been a couple of changes to Section 42, subsection 2. And again, they relate to some extent to the naming convention changes regarding politically exposed persons, broadening an accountable institution's duty to provide for the manner in which and the processes by which enhanced due diligence is conducted, not just on business transactions or relationships, but also on high-risk single transactions. So we encourage you as accountable institutions to really make an effort to familiarize yourself with these amendments to the FIC Act. And the reason being, it requires you to go and review your RMCP. The amendments to Section 42 also link into amendments to our CDD requirements in the Act. So in particular, Section 21B, 21C, as it relates to enhanced due diligence, and very importantly, ongoing due diligence. And we all know that it is in any case already an existing requirement in the Act that has not been amended, that you as an accountable institution must frequently review your RMCP. With reviewing of an RMCP comes board or senior management approval, and of course to make sure that your RMCP is actually implemented by your staff, you have to give them training. So let's make sure as a collective that this doesn't catch us off guard, and the amendments are in place, they're enacted. So if you have not yet done so, please use the opportunity of the benefit of this webinar to become aware and familiar with these amendments and see and understand how the guidance issued by the FIC can also assist you in bridging that gap between this is the legislative requirement, but I'm not sure on a practical day-to-day level how I must meet this objective and requirements. So with that being said, it was a mouthful. I want to hand over to Yolande, and just before I do so, Yolande, thank you again very much for joining us. I think just before we tackle all these guidance products included in our very exciting agenda, perhaps just give our viewers your sentiments on what is the value of guidance products. Why does the FIC employ experts like you to draft these guidance products and to finalize them? How can these guidance products help our accountable institutions? I'm handing over to you, Yolande. Thank you.
Thanks so much, Michele. Thank you to the colleagues, all the colleagues at the Financial Sector Conduct Authority, my colleagues that are joined today. And again, thank you for this opportunity to be part of this recording. I like the way you've introduced the guidance, being that the question is, what is the function of guidance, and why does the FIC issue guidance? So part of our core function here at the Financial Intelligence Center is obviously providing guidance to accountable institutions on how to apply the legal requirements and comply with the legal obligations. Guidance is aimed at providing that practical advice for the institution to advise them on which steps or controls they can put in place to meet the objective, the legal requirement. So that being said, guidance is obviously authoritative in nature. And so we do encourage accountable institutions to apply whatever principles is set out in guidance products. And when an inspection does take place, and non-compliance is found to non-compliance with a FIC requirement or a regulation requirement, and there was guidance issued on that specific principle or legal obligation at least, then enforcement action can definitely result. So it's very important for accountable institutions to definitely understand the guidance that has been issued and apply the requirements. So with that being said, I'll move on to the actual overview of the public compliance communications, starting with Draft Directive 6, and as well as Public Compliance Communication Draft 116. So both of these documents was issued simultaneously by the Centre. What Directive 6 aims to address is a gap that we found that became apparent through the Financial Action Task Force mutual evaluation. So as you're aware, the FATF for short, they conducted a mutual evaluation on South Africa, and it was found that there was key requirements that South Africa has not implemented as a country. One of such requirements, if you look at recommendation 8 of the FATF recommendations, or at least recommendation 18 of the FATF recommendations, you'll see requirements around internal rules are set out. And of these requirements includes the requirement to screen your employees. Accountable institutions place a lot of focus on understanding and knowing who their clients are and screening their clients. And that's obviously in line with the legal requirement as set out in the FIC Act. Directive 6 then extends that to say, screen your employees at onboarding and also regularly thereafter in a risk-based manner to see whether or not your employees are exposing you to any money laundering, terrorist financing, or proliferation financing risk. So the directive is an extension basically of the FIC Act requirement. It states the accountable institution must screen the employees' competence and integrity, and they must also screen the employees against the targeted financial sanctions lists. So there's 3 core requirements that come out of that directive. The manner in which you need to screen your employees must be stated in your accountable institution's risk management and compliance program. And also you need to keep records of that screening. When an inspection is conducted on an accountable institution, the accountable institution must be able to evidence that they have in actual fact screened their employees in alignment with Directive 6 of as issued by the FIC. Along with Directive 6 is the draft public compliance communication. Again, PCCs are a form of guidance issued, and it's got authoritative nature, although it is not a directive is legal in nature. It places a legal obligation on an institution, whereas a guidance product is a bit different. It's there merely to provide you with guidance, which is authoritative in nature. That being said, I'll go a bit further into, or deal a bit further with the draft Public Compliance Communication 116. It is issued in accordance with draft Directive 6, and it sets out more information on what competence might entail, what integrity might entail, and also what steps, at which point you need to screen your employee and so forth. So just the examples of this, and it's good to mention that both these documents apply to all accountable institutions. It applies to FSPs as well as designated non-financial businesses and professions. If you look at draft PCC 116, you'll see there it sets out competence might be with reference to previous employment, getting references from previous employment, also looking at your qualifications and accreditations. Integrity, on the other hand, speaks to the fact that the employee is fit and proper for their role, and also they don't have any criminal record. Also, if that employee held a senior role at an accountable institution previously, and if that previous role, in that previous role, that accountable institution was then found non-compliant in terms of AML legislation, that type of facts needs to be taken into account. It's part of an integrity check on the employee. Also, you need to screen your employees, obviously, against the target financial sanctions list, and to check whether or not that employee is designated on a list. So those are the core 3 elements of screening. And we say that if this type of screening, apart from screening against the TFS list, the screening for competence and integrity needs to be done on a risk-based approach. What we mean when we say that is that if an employee role poses a heightened risk, for example, if the employee sits on a high-risk client committee and they take decisions that has a huge impact on the accountable institution, then that employee role poses a higher risk to the accountable institution overall. In that type of scenario, the accountable institution can conduct enhanced screening on that type of employee. Enhanced screening would be, for example, checking whether or not the client was ever struck off an attorney role, or the client is found to be a delinquent director, or at least the employee, is found to be linked to a politically exposed person. That's sort of enhanced screening that you can apply when you are dealing with an employee that poses a higher risk. So yeah, employee screening is definitely there to protect the accountable institution against abuse within by employees using the accountable institution. Michele, I'll just ask you at this point if there's anything that you would like to maybe expand on or question in this regard.
Yeah, Yolande, this is such valuable information. And I think this is also very demonstrative of the fact that we as South Africa subscribe to global AML CFT standards. I mean, you mentioned the FATF standards, the recommendations. So often if our accountable institutions are not sure, but where does these obligations originate from? What is the purpose? I think this really makes it very clear, and again emphasizes the value of guidance products. With that being said, let's move on to PCC 43. Customer due diligence is something that is near and dear to our hearts as supervisors, and it certainly is near and dear to the hearts of accountable institutions who apply a risk-based approach and who really make the effort to understand who is it that they do business with, right? It sounds always like a very basic requirement, but it's not necessarily. So the FIC has now clearly developed this guidance product on the use of third parties for CDD. So as you take us through this, I would appreciate if you can highlight just, what does this actually mean? Does it mean for me as an accountable institution, someone else can do my customer due diligence for me? Does it mean I'm still responsible for doing that? I think that's the kind of questions in practice that accountable institutions might struggle with. And, we know that in the past, before 2017, there were certain exemptions that applied, and certain compliance behaviors might have developed that became habits. So I would like for you to take us through this PCC so that we can see what our accountable institutions can and cannot do. There's freedoms and limitations, and I'll hand over to you.
Thanks for that, Michele. So yes, Public Compliance Communication 43, it deals with customer due diligence, where you've got two accountable institutions, and those accountable institutions have a shared client through a joint, say, single transaction or joint business relationship, and in which scenario one accountable institution or the primary accountable institution wants to obtain or gather information, CDD information, from a secondary accountable institution. If you look at the PCC, and I'm sure for those of you who've been in AML for quite a number of years, you'll know that we previously had exemptions to the FIC Act. Those exemptions have been withdrawn. However, there are certain principles which can be applied by accountable institutions. One of which is a scenario where an accountable institution or first accountable institution can rely on a third-party accountable institution or ask a third-party accountable institution to gather customer due diligence information for them. In this type of scenario, and the PCC highlights it very clearly, it needs to relate to a shared client for a specific business relationship or a specific single transaction. So an example for example's sake, if you think of a client that approaches a bank to apply for a bond, and the bond is linked to maybe life insurance or so, that type of products are so closely linked. One could say that it is being provided to a shared client in a business relationship or single transaction type scenario. And in that instance, the primary accountable institution can then request information from the third party accountable institution. There is certain caveats to that. The obligation or the accountability in terms of the FIC Act, in terms of Section 21 of the FIC Act, you cannot transfer your accountability to another accountable institution. It remains your accountability to comply with the FIC Act. So there you will have to make sure that the information you're gaining from the third party accountable institution is sufficient for your purposes as the primary or first accountable institution. You also have to make sure that you conduct your own risk assessment on your client. The risk that the client poses to one accountable institution might differ to the risk that that same client poses to another accountable institution. So risk is very unique to your own environment. You need to risk rate your client and set a risk rating according to your risk-based approach. Also check whether or not the information you've received from that third-party accountable institution is adequate to meet your requirements in terms of your RMCP. So the liability will never ever move over from one accountable institution to another accountable institution. It remains the obligation. In practice, this is quite common, where one accountable institution actually relies on another accountable institution to, or at least asks another accountable institution for their CDD information. There is certain things that you can't ask another accountable institution for. Like I've mentioned, the risk rating of your client. You need to conduct your risk rating on your own as the primary accountable institution. Gain all the information, all the relevant factors that you need to consider for risk rating your client. You can't outsource screening. So any screening that's performed on your client, there also just be aware that if you do find a designated person a person that's designated on a TFS list, you need to report. And also reporting obligations cannot be outsourced to another accountable institution. Obviously, reports need to be maintained, they need to be held confidentially and so forth. And all of these type of factors are taken into account when you ask for assistance from another accountable institution. So yeah, that is very key to understand. It relates to a shared client scenario only. I guess there again, Michele, if there's points that we need to expand on or so forth from yourself or from Motso.
Yes, thank you so much. So on the topic of customer due diligence, I know we as the FSCA worked very closely with you guys at the FIC when you were developing Public Compliance Communication 52. And it is so that it was specifically drafted to find application in the authorized user space. But I know that Gemotso has some questions about this that you can probably assist with. Gemotso, I'm handing over to you in the spirit of hashing out accountable institutions CDD obligations. Thanks.
Yes, thank you, Michele. So Yolande, my question relates to a scenario involving a client of an authorized user of an exchange where such client is not a shared client. Please explain why is it important for an authorized user to collect or to obtain information about the client base of its client for purposes of determining money laundering and terrorist financing risks? Over to you, Yolande.
Thanks so much. We've received quite a bit of requests from industry bodies on this type of scenario where an accountable institution has a client, or which client in their own right is an accountable institution as well. And obviously that client that is then an accountable institution has their own clients, which we'd refer to maybe as an underlying client in this type of scenario, or the client's client to be more accurate. That type of scenario is covered in Public Compliance Communication 52. It is very different and distinct to what Public Compliance Communication 43 sets to deal with. So in the scenario of Public Compliance Communication 52 at least, it is focused at providing guidance from a risk-based approach, and what accountable institutions, specifically authorized users, need to consider when conducting their client risk assessments. So an authorized user might, for example, onboard a financial service provider. That financial service provider has their own clients. In order for the authorized user to fully understand the risk when onboarding this FSP, the authorized user also needs to understand understand a bit more about the FSP's client base. That is to gain a full holistic sense of the risk that the business relationship or single transaction might bring about from dealing with that specific FSP. So it's not a case of the authorized user, the FSP's clients is the authorized user's clients. No, it's more a case of conducting a holistic risk assessment on an FSP who's a client of an authorized user. So in that type of scenario, the authorized user can ask that FSP for additional information on the FSP's client base. And that information can include information on whether or not the client base is more so legal persons or natural persons. Obviously, we know clients that are legal persons, there's that added risk of not knowing who the ultimate beneficial owner is, or added risk of criminals trying to hide behind a legal entity at least. So they can ask that type of question. Also questions on whether how or not the FSB's client base is more the politically exposed persons. Do they have a high amount of politically exposed persons on their client base? Do they conduct sanction screening? What are their processes and procedures for customer due diligence? All these type of questions the authorized user can then collect from that FSB, which is the authorized user's client, and take that type of factors into account to risk rate that FSB and determine an overall holistic risk rating. So in that scenario, it's completely the business relationship between an authorized user and an FSB is completely separate from the business relationship between the FSB and their client, or their at least underlying client in the scenario. Yeah, like I said, that PCC 52 is really focused at providing guidance on the risk elements. And it also was one of those findings in the FATF mutual evaluation, stating that more risk-focused guidance needs to be issued. And I think that's where that scenario comes into play. Motsoi, over to you. Thank you.
Thank you, Yolande. This is very useful information that you've provided to us, but it's very important for authorized users to read and to understand PCC 52 and to review their RMCP. So thank you so much for that, Yolande. Michele, I'm handing it over to you.
Thank you, colleagues. Yes, Yolande, I think next on the agenda we have Draft Guidance Note 7A. So what I would like to know before you take us through the detail is this. We all know that Guidance Note 7, it's like it was like a compass for I think accountable institutions. It made understanding of the amendments to the FIC Act in 2017 really, really easy. So now the FIC is developing Draft Guidance Note 7A, and I'd like to find out, is 7A going to replace Guidance Note 7, or what are the differences? It's just going to supplement it, because I'm very sure, even though it's still in draft, what you're going to share with our accountable institutions in this webinar is something that I should keenly take note of, considering the considerable impact that Guidance Note 7 has had on our understanding. So I'm handing over to you, Yolande, to address those questions and just take us through the details of Draft Guidance Note 7A. Thanks.
Thanks so much. So, like you say, Michele, Draft Guidance Note 7 is really the starting point when we advise accountable institutions on any obligations in terms of the FIC Act. We do also state to them, have a look at Guidance Note 7. It came about after the amendments in 2017. There was huge amendments to the FIC Act in 2017, and Guidance Note 7 was published around that time. It really does provide a wealth of information. Guidance Note 7, as currently it stands. However, we have issued a draft Guidance Note 7A, and important to note is that draft Guidance Note 7A actually only is intended, when it is finalized, it's only intended to replace Chapter 4 of Guidance Note 7. Chapter 4 deals with risk management and compliance program. So that's the only chapter that it will replace when it is finalized. And this draft Guidance Note 7A is more focused at financial institutions, be it your FSBs, be it your banks, life insurers, and so forth. It's very specific to that industry, although it can provide guidance to the DNFPP sector as well. We do advise accountable institutions to also have a look at PCC 53, which also deals with risk management and compliance program, where the accountable institution is a bit more smaller, a smaller sized accountable institution. PCC 53 does provide a lot of useful information as well. But just back to the reason we had to, or at least draft guidance note 7A was required. So the regulators, being SARB, together with the FSCA, together with the FIC, have identified the need to provide more guidance, specifically to the board of directors of accountable institutions, just advising them and confirming their obligations in terms of the FIC Act. So if you look at draft guidance note 7A, you'll see a strong, there's two strong themes that come through in that guidance product. One being the obligations of the board of directors. Section 42 of the FIC Act places the obligation on the board of directors. Where there's no board of directors, the senior management of an accountable institution, to approve and put in place an RMCP. And it also states that that RMCP must be adequate to ensure compliance with the FIC Act. So these obligations must not be taken lightly by a board of directors or senior management. It's really imperative that all the obligations are complied with. The board of directors know exactly what is part of the risk management and compliance program. The board of directors must approve that risk management and compliance program, and whichever documents that are linked to it, they have to actually evidence that approval. And also they need to make sure that the RMCP is kept up to date and current. The risk changes over time, so therefore it's not sufficient if a board of directors approve an RMCP once every 3 years. Risk does change, and we do advise on an annual basis that RMCP needs to be updated and also approved. So there definitely a strong theme of setting out the obligations of board of directors and or senior management. And then draft guidance note 7 also has a second part to it, if you could state it that way. That second part provides guidance on what exactly needs to be included in a risk management and compliance program. So if you look at, if an inspector walks into your offices tomorrow and they ask for an RMCP, in all event, that inspector would want to see a part A, a part B, and a part C to that risk management and compliance program. Part A being your risk assessment. So you as a financial service provider or whichever else accountable institution you are, you need to show that you've conducted a business risk assessment, a client risk assessments, as well as new product and process risk assessments. You need to know, you need to be able to explain where risks lie within your environment and how you mitigate that risk. Part B deals with the risk mitigation and management. What all controls you have in place to comply with the FIC Act must be set out in your RMCP, and how to mitigate your risk. All of that controls must be set out in your RMCP. And also, you need to monitor adherence to that controls and adherence to your risk-based approach. So part C must set out how the accountable institution is going to monitor adherence to the RMCP and the FIC Act as well. So those are really key elements of an RMCP, and this draft guidance note 7A provides that guidance on it. So yeah, it does also set out additional factors that you can take into account, noting that not all accountable institutions are the same. Different accountable institutions face different risks. dependent on your size and complexity, your RMCP is definitely going to be different. You need to look at the diversity of the operations, where the accountable institution operates. If it operates in different geographic areas, that also plays a role. Your clients that you onboard, the different types of clients, the different types of products you provide, all of that type of factors plays a role when you are developing your RMCP. So it must come out clear in your documented version of the RMCP. Obviously, if you are part of a group, the RMCP needs to be adequate for each accountable institution that forms part of the group, and it needs to be customized to each accountable institution that forms part of that group. So keep that in mind as well. And obviously, it needs to be, as I've mentioned, reviewed to ensure that it remains current and up to date and meets the requirements of mitigating risk within the accountable institution. What we do foresee is that obviously this draft guidance note has been published for a second round of consultation towards the end of last year. So whatever consultation comments have been received, the FIC together with FSCA and the SARB review those comments, and a final version of this will in time to come be published. And it will obviously replace only Chapter 4 of Guidance Note 7. That's key to understand. Thanks, Michele.
Thank you, Yolande. Yes, I think this is I don't want to single this out. All the guidance products we are discussing today, the amendments, they're very important. But you know, I cannot imagine conducting supervisory activities and at any point in time omit assessing a risk management and compliance program. It will always form part of our scope. And that customization really is critical because a risk management compliance program must work for that particular accountable institution. And just because a template or a general document is provided, despite the fact that it might be called a risk management and compliance program, in some instances, unfortunately, it does in fact not constitute such a program. And we really want to encourage our accountable institutions to pay close attention to the customization. And also, as you did mention, PCC 53, I know that was predominantly aimed at the DNFPPs, but us at the FSCA has actually also created awareness around that PCC because, like you said, it really finds application in smaller type accountable institutions, less complex businesses. And it's the principles. I mean, all those principles are based on the FIC Act requirements at the end of the day. So I would recommend that if someone struggles and you really don't know where to start, go and have a look at PCC 53. And we as FSCA also have an RMCP framework that we are busy reviewing now in light of the amendments to the FIC Act. So bottom line, there can't be excuses. There's a lot of guidance that's out there and available to our accountable institutions to really make sure that they have effective RMCPs. Yolande, we have to move on to our next agenda item. And that, of course, deals with PIPs and PIPs. And I'm so glad that this naming convention has now actually come to light. I've always struggled to remember exactly what does FPPO stand for and what does DPIP stand for. So personally, you've made my life much easier now. We've mentioned in the beginning of the webinar that this has been part and parcel also to the FIC Act amendments. But I'm going to hand over to you so you can take us through Public Compliance Communication 51. And I know our accountable institutions should take a keen interest in this guidance product because there's some practical things that they struggle with, such as where do I find a list of PIPs or PIPs? And maybe you can help them with that. So I'm handing over to you, Yolande. Thanks.
Thanks. So this Public Compliance Communication 51 deals with politically exposed persons, as it's now referred to. I need to just highlight that this draft, the current draft, will definitely be updated in time to come, or in line with the recent amendments of the General Law Amendment Act. So, but the principles that are contained in public compliance communication can definitely still be applied. The updates will be more so around the time frames that's indicated in this draft, as well as the naming conventions. So definitely you can have a look at this draft. What is still very useful of Public Compliance Communication 51 is the websites that's found on the last part of the draft, the last few pages of the draft. It actually gives you websites that you can search to find out whether or not your client is a politically exposed person. So just to highlight the amendments that came through the General Law Amendment Act, the naming convention was first off changed. So it's now referred to as a domestic politically exposed person and a foreign politically exposed person, and a new category of prominent influential person was introduced. That goes along with Schedule 3A, 3B, and 3C of the FIC Act at least. Schedule 3A deals with DPIPs, Schedule 3B deals with FPIPs, and 3C deals with PIPs, as we refer to it in this presentation. It's important for an accountable institution to understand that now, and I want to emphasize what Michele mentioned earlier, is that the principle of once a PIP, always a PIP now applies. If you look at the updated wording of Schedule 3A and 3B, you'll see that the reference to a domestic prominent influential, domestic politically exposed person is a person who yelled for a period exceeding the past 12 months. So that wording has been done away with, 12 months prior at least. That specific reference to 12 months prior has been done away with. So now it reads more along the lines of, if a person has at any point in time held a position of domestic politically exposed person, then that person is a PIP for all intents purposes for the FIC Act. And there's certain requirements that you obviously need to comply with when you're dealing with a PIP. Those requirements are set out in Section 21F, G, and H of the FIC Act, and we'll deal with that in a little bit. So for an accountable institution, when your client approaches you, and it's very important for you to determine whether or not that client is a PIP. So how do you go about that? And we do recommend that you ask the client first and foremost to self-declare. Declare whether or not that client is a politically exposed person, but you also need to remain aware that there's a lot of instances where that client might misrepresent the fact that they are a politically exposed person, especially where a client wants to misuse an accountable institution's services for money laundering purposes or so forth. So self-declaration is not always the preferred method. If you do ask clients to self-declare, that's a good practice. But in addition to that, you need to actually go onto websites and check whether or not that client is a politically exposed person. You need to check whether the client, beneficial owner of a client, as well as person acting on behalf of a client is a PIP. The manner in which you check that, being through self-declaration or checking on websites, the manner in which you determine that needs to be set out in your RMCP. You also need to note that when you're onboarding, if it's a domestic PIP, then that PIP you need to assess the risk, because not all domestic PIPs pose higher risk. Only where that domestic PEP is a higher risk, then you would apply 21F of the FIC Act. When you're onboarding a foreign PEP, it's a bit different. That foreign PEP is taken as a high risk PEP automatically. And there you would apply 21G of the FIC Act. So if you just go on to the next slide, you'll see there requirements set out is that you need to conduct enhanced due diligence when you're dealing with high risk domestic PEPs or foreign PEPs. You need to obtain senior management approval. You need to get information not only of the source of wealth, not only of the source of funds, but also of the source of wealth of that client. You also need to conduct enhanced ongoing monitoring on that client. So that would apply when the client is a high risk PEP, high risk PEP, or a foreign PEP. With prominent influential persons, we also advise that you need to actually treat the requirement of once a PEP, always a PEP doesn't really apply to prominent influential persons. So the recommendation, and it's a strong recommendation that's made, that apply the same principle once a high risk prominent influential person, always a high risk prominent influential person. If you onboard person X today and that person is a high risk PEP, maintain that person as a high risk throughout the business relationship or so. That's just one of the recommendations that we will carry forward in the updated version of the PCC 51. Schedule 3C that deals with PCC, that deals with PEPs, is not yet operational. In time to come, a list will be published by the National Treasury, setting out what all persons actually deal with or provide procurement to state organs and so forth. So also just have a look out. That will be published in time to come, but that's also quite important for you to know. De-risking. So we strongly advise against de-risking purely based on the fact that a client is a DPEP or a DPEP, or DPEP at least, and an FPEP. We say that keep that client on board and just manage that risk. De-risking is not a form of management of risk. If an inspector walks into your institution and sees that you de-risk purely on the basis that a client is a PEP, you will be in, that inspector will in all probability make a finding against your institution, in that your risk-based approach is not really up to, it's not optimally, operating optimally at least. Michele, any comments in this regard? Thank you.
Really, Yolande, I just also, as FSCA, support the FIC in echoing that we really do not support de-risking. It simply has the consequence that you lose the benefit of monitoring results, you lose the benefit of financial intelligence, and like you rightly said, that is actually not a form of applying a risk-based approach. And then also just to add that applying a risk-based approach it's intrinsic, it's very critical, and we really have to apply ourselves to applying a risk-based approach. But I would also just add to that approach, or for that approach to be proactive, so that we not only on a reactive basis find that something has already happened. So not be overcautious, apply one's risk-based approach, but really be proactive in our efforts. Yolande, only 2 agenda items to go. With the amendments to the FIC Act included in the General Laws Amendment Act, there were also amendments to POCTA TARA. And I know that you are just on a high level going to touch on PCC 44, and tell us more what's happening there. I'm going to hand over to you. Thank you.
Thanks. So, Public Compliance Communication 44, this PCC is also going to be updated. In its current state, it is subject to amendments because of the POC-DOTARA Amendment Act. The main change that came about from the POC-DOTARA Amendment Act is Section 25 of POC-DOTARA was repealed. So in terms of Section 25, actually the South African Police Service would publish a list on their website of sanctioned or at least designated individuals. That Section 25 has fallen away. And what happens now is that the director of the Financial Intelligence Center publishes on the FIC website a list of designated persons and entities. That list of designated persons and entities as published on the FIC website is the consolidated list. Accountable institutions only have to screen against that list that's found on the FIC website in order to comply with the obligation as set out in Section 28A of the FIC Act. So that list would include persons that are designated for reasons of terrorist financing, as well as maybe proliferation financing. And also there's other atrocities that people are designated for. So that is a comprehensive list that's published on the FIC website in terms of Section 26A of the FIC Act. What is important to mention is that South Africa does not have its own autonomous or at least domestic sanctions regime. What we do is we rely on publication resolutions that are published by the UNSC. So those resolutions are published, and South Africa would then go and take that the content of that resolution, and the director would then publish that on the FIC website. And through that publication, it becomes part of our law, part of our legal requirement. So that's done in terms of Section 26A. And then if you look at Section 26B, it states that no person may provide finances or services to a person that's listed on a targeted financial sanctions list. So in order for you to, as an accountable institution, in order for you to know whether or not a person is listed on a targeted financial sanctions list, you need to screen your client's information against the TFS list. Section 28A of the FIC Act states that all accountable institutions must scrutinize client information against the TFS list. That could be done automatically, or if you're a smaller entity and your client walks in and you've got that client information, you can then proceed to go to the FIC website and screen it manually against the list that's available on the FIC website. Part of targeted financial sanctions is first off, obviously you'll scrutinize client information, or at least screen. And then if you do find somebody is on the list, you need to automatically freeze that person's funds, be it a prospective client, be it an existing client, be it somebody that's sending funds to your client. The minute that funds hit the client's account, you would freeze that client's assets. You cannot provide services to a person that is designated on a sanctions list. After you have applied a freeze to that designated person's assets, you will then go on to report in terms of Section 28A, and that would be a terrorist property report that you then file with the Financial Intelligence Center. So yes, public compliance communication It was there to set out the two different sanctions regimes. Since the publication of this PCC, it has been merged into just one sanctions regime, which is found in Section 26A, B, and C of the FIC Act, read together with Section 28A of the FIC Act. That's important for you to understand and apply in your dealings with your clients. Thanks, Michele.
Excellent. Thank you, Yolande. This was certainly informative. And I think, again, you know, the whole thing with what should be in your RMCP as an accountable institution, again, comes to the fore. Your screening obligations, your freezing obligations, your reporting obligations. Because how else will you know what to do if it's not in your RMCP? So thank you for that. And going to our last agenda item, a lot in the same vein, but please just quickly take us through Public Compliance Communication 54 then as well, because it links so well into what you've just explained as a basis. Thank you, Yolande.
So, emanating from also certain of the Financial Action Task Force findings was the need to issue guidance around proliferation financing. A lot of accountable institutions didn't have an understanding of what exactly proliferation financing is, how it differs from terrorist financing, and also what controls there are in place to combat proliferation financing. So yeah, where we do update PCC 44 together with PCC 54, you'll see that it is more in line. There is one sanctions regime right now that we apply in terms of the FIC Act, which covers both terrorist financing and proliferation financing. Just important to mention there is certain definitions set out in this PCC 54 around what exactly proliferation of weapons of mass destruction is. So have a look at that definition. What I do want to point out is the new definition of proliferation financing, which is found in the General Law Amendment Act. And it reads that proliferation financing activity means an activity which has or is likely to have the effect of providing property, a financial or other service, or economic support to a non-state actor that may be used to finance the manufacture, acquisition, processing, development, transport, transfer, or use of nuclear, chemical, or biological weapons and their means of delivery, and includes any activity which constitutes an offense in terms of Section 49A of the FIC Act. So from that definition, you can see that proliferation of weapons of mass destruction, basically, it's the creation of weapons of mass destruction, be it a nuclear weapon, chemical weapon, or biological weapon, and also their means of delivery. So you find there is countries that are actually creating weapons of mass destruction for illegitimate purposes. And those countries have been subject to immense scrutiny, and also a lot of trade sanctions and sanctions have been placed against entities in that country. And for that reason, we had to also issue this PCC 54, which provides then guidance around it. So again, just to go through the points of the actual PCC, you will see that it deals again with Section 26B of the FIC Act, which states that no person may provide finances to another person who is proliferating weapons of mass destruction. Section 28A of the FIC Act, there's a definite requirement on an accountable institution to scrutinize their client information. Remember, persons are designated on a TFS list where they are providing financing for the proliferation of weapons of mass destruction. So that type of entities, accountable institutions cannot provide services to. And then Section 26B of the FIC Act, no person may provide services. That entails freezing. So if you have anybody that's listed on a TFS list, again, your obligation to freeze that person's funds comes into place, and then report the person through in terms of Section 28A of the FIC Act. So those are your set principles in terms of the FIC Act and targeted financial sanctions. But in addition to that, there are certain risk-based controls that you can put in place within your institution that assist you in combating proliferation financing. So go through the PCC. There is certain red flag indicators and factors that you can take into account as part of your risk-based approach. Know that oftentimes a key risk when it comes to proliferation financing is that criminals often use legal entities to hide behind, and they would then use that front or shell company to actually gain proceeds and use that proceeds for creating weapons of mass destruction. So legal entities, also if that client deals in dual-use goods or controlled goods and activities, they can treat that client type with a bit more care, a bit more enhanced due diligence you can apply to that type of factor if a client deals in controlled goods and activities. Just on geographic risk factor. So we know there's a certain, or at least two countries that are in particular high risk from a proliferation financing perspective, that is North Korea and Iran. And where transactions relate to clients that are based in that jurisdictions or clients that are nationals of that jurisdiction, that type of factors you can also take into account. And also, obviously, your product factors. If your client, or at least also sector, the sector that your client deals in is a high-risk sector, take that into account. All of that type of factors can be taken into account when assessing risk from a proliferation financing perspective. So targeted financial sanctions are different to activity-based financial sanctions. The obligation that's set out in the FIC Act is focused on targeted financial sanctions. That is where somebody is actually listed as a designated person on a TFS list. Activity-based sanctions are a bit different and broad-ranging. You can find that it states that nationals from certain countries are prohibited from certain income-producing activities. A form of activity-based financial sanctions can also be a trade and commodity ban. And so they're wide-ranging. It's also the accountable institution's obligation to understand these activity-based financial sanctions, and where they have a suspicion that any activity might include the contravention of activity-based financial sanctions, they can then report through to the center in terms of Section 29 of the FIC Act. So that being said, again, I'd like to emphasize the fact that PCC 54 is also very aimed at providing guidance around the risks of proliferation financing and for the accountable institution to gain an understanding of proliferation financing. And therefore, it's a risk-focused guidance product. And you'll see that theme coming quite strongly out in guidance products that the FIC has issued of late. It goes along with the obligation on the accountable institution. The accountable institution definitely needs to understand their risks and put in place that controls that mitigate all sorts of risks, be it terrorist financing risk, be it proliferation financing risk, be it the risk of you dealing with a politically exposed person, all of these risks you need to take into account and put in place measures within your institution to comply with the FIC Act requirements. That being said, thank you, Michele. I'll hand over back to you.
Yolande, I've learned so much today, and I'm extremely confident that our accountable institution similarly is going to extract great value from this session today. I really want to thank you, our colleagues at the FIC, Mzwandile and Yolande, for your time, your contribution to creating this awareness in the supervisory environment where the FSCA is the supervisory body. Thank you to my colleagues in the FICA Supervision Department, Mpo and Gemotso. And we look forward to building on future collaborations with the FIC, of course, and focusing on these very important topics to make sure that despite the level of knowledge and sophistication, every single accountable institution understands the message. They know where to find assistance when they have questions, and that the information provided by supervisory bodies and the Financial Intelligence Center is pitched on a level where comprehension is made easy, and there will be a consistent understanding and approach, so that we can make sure that that level of compliance, that needle that we want to keep on pushing in the positive direction, that bears fruit. So again, from my side, thank you so much for your contributions, and until next time.